Well, as I told you, as we go to air, the government is guillotining multiple bills through the Houses of Parliament to ensure the last day of the sitting year brings through as much legislation as it physically can. Among those bills, a $22 billion Future Made in Australia policy, and as important, changes to the Reserve Bank's charter that will see a separate board created to decide on interest rates. Now, keen watcher of the Reserve Bank is the Commonwealth Bank's Head of Australian Economics, Gareth Aird, who joins me now. Gareth, the Governor of the Reserve Bank actually happens to be speaking at the CEDA annual dinner tonight.
Yeah.
So we just might get a little bit of something out of the Governor, perhaps.
Yeah, look, it's a coincidence that she was down to speak tonight, and then this bill's actually gone through today. You would imagine that if it's not covered explicitly in the Governor's speech, she will be asked in the question and answer to opine on the changes that are coming in terms of the establishment or the creation of a monetary
From your point of view,
board.
this has been stuck in Parliament. Does it actually matter terribly much as to whether there's one or two boards of the Reserve Bank?
It comes down to who's actually on the board itself. If the Monetary Policy Board is just made up of the current board members, then we're not really thinking anything's going to be too different next year, other than the fact that we'll get published unattributed votes after each meeting.
And is that a good thing? Do you think that's healthy?
I think so. It'll give us a sense of how close or not the board is on any particular meeting to potentially moving rates if they don't move rates, because if we see that there's division within the board over what they think should be the appropriate policy move, then we would get a sense of how close or not the board might be to moving. But if, for example, the unattributed votes came in 9-0, then we know the board's in complete agreement over the current stance of monetary policy.
OK, the other thing that happens tomorrow is the latest economic growth figures for the previous quarter come out. Now, you're suggesting at the moment 0.4% growth for the quarter, 1.1% for the year. As we've been hearing, this is anaemic growth. The average growth is around about 3% over the very long run for Australia. So Australia's not growing terribly much. Does that have any influence on where the what the Reserve Bank does next?
Well, the national accounts, which are coming out on Wednesday of next week, are going to give us an update on Q3 GDP. And the RBA is expecting a set of figures which shows that the economy went backwards again in terms of output on a per capita basis. And we've been that way now for the past 18 months. That is a natural response to having monetary policy at a restrictive setting.
But that's very hard for politicians, of course, because even though we're not in an official recession, as you point out, these numbers out next Wednesday, I should have corrected myself. What happens there is that is the mood, that is the feeling of the population, and whether the Reserve Bank should be responding to that rather than responding to the actual economic data around employment and also around inflation.
Yeah, look, that's right. And what's been the case over the last 6 to 9 months in particular is that the private economy hasn't grown at all. In fact, the only growth that we've had in the economy has come through on the public side. I mean, the message really from the GDP data has been that the overall economy is growing, but it's not keeping up with growth in population. So the share of the pie that each individual is getting effectively has been contracting. Now, we don't think that's going to be the case as we move through 2025 if rates start to come down and economic growth starts to pick up. But that's the place that we've been in now for the best part of the last 18 months or so. But it has felt like a squeeze for the average household.
So there's a squeeze on the average household. And what the Reserve Bank seems to be waiting for is either A, core inflation to come down. We saw monthly inflation where core inflation has gone up. Now, whether that's real when the quarterly data comes out is another matter. But then if you really sort of bring this all back together again, you actually go and say that the important non-accelerating inflation rate of unemployment, so this is called NAIRU, which they look at, you're saying that the Reserve Bank has got this set too high. Now, if that's the case, then arguably there is an argument for them to start cutting interest rates sooner rather than later. Rather than trying to wait for the unemployment rate to go out to 4.5%, maybe if they've got that number wrong, they should actually have a case for going much earlier.
Yeah, look, it could be the case here that non-inflation adjusted rate of unemployment, the NAIRU, is actually lower than the RBA's implied profile suggests, which is that an unemployment rate of around 4.5%, which is almost half a percentage point above where it is currently, is about the level of unemployment that generates inflation consistent with the inflation target. Now, we think that unemployment rate is closer to 4%, that will give you inflation within the target.
So this is the sense of where is full employment, isn't it? That's really what we're talking about here.
Exactly right. The reason we don't quite know where it is pre-pandemic, the unemployment rate was around 5%, and that was too high because wages growth was too low and we had inflation below the target. We came out of the pandemic, the economy boomed, unemployment went all the way down to 3.5%. That was too low because at one point wages growth was running above 4%. That's clearly not consistent with the inflation target. But as the unemployment rate's been trending up, what we've seen is that wages growth has been coming down. If you look at the last 3 quarterly prints on the wage price index, they've come in at 0.8% growth on the quarter. So we're running now at an annualised wages pace of about 3.25%. Now that's about where you want it if you've got an inflation target of 2 to 3%.
Yes.
And that's occurring with an unemployment rate of around 4%. So I think it makes a pretty strong case that that level of unemployment that we can run in the economy is probably around where it is now, not much higher.
I'll tell you what, it's a fascinating thing, and we'll come back and do this again because all of these things are interlinked, including the way the Reserve Bank sets interest rates. Gareth Aird, always good to chat to you.
Good to chat,
Ross. Thanks for your time
Cheers.
today.